Over the last 20 years, ETFs have grown in popularity and evolved into a core part of portfolios. We see three key moments that help put ETFs and index investing front and center. The first key milestone is the dot-com bubble of March 2000. This was the peak mania and interest around dot-com stocks, and a lot of this euphoria around the growth was really tempered when many of these highly valued stocks went out of business. It really started by putting greater focus on diversification and building portfolios across sectors and geographies. At the same time, ETFs and the availability of ETF strategies started to increase. In fact, between 2000 and 2014, the amount of money invested in index funds grew by 5 times. Similar to the dot-com bubble, but on a more global scale, markets were rattled back in 2007 and 2008 when a housing and a banking crisis created the global financial crisis. Crises in some ways can be an agent of change. Investors and even regulators demanded more transparency and a clearer understanding of the risk of an investment. Additionally, liquidity became important. ETFs and index brought just that. Investors who were diversified benefited over the next decade in what became a historical bull market. The third key milestone is in August of 2019, when money in US index funds surpassed that of active strategies for the first time. And really, this signaled the growth that we saw over the prevailing decade was a huge shift in an investor's mindset, such that indexing had gone mainstream. The bottom line is that we've seen a generational shift in how investors access markets and build portfolios. ETFs have championed investor progress by democratizing access and giving greater control with a hyper-focus on giving investors better value for their money.
Visit www.iShares.com to view a prospectus which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Investing involves risk, including possible loss of principal.